Hello and welcome to this week's episode for Spy Trader Now. I am your host. My name is Ken. I am traveling this week, so I am in an airport trying to get this video banged out. So I apologize for the background noise that you're going to experience during the video, but I'll try to be as brief as possible. This week's episode is should be short anyways because there were no trades made during the week. Our portfolio is still up 1.6 year to date. And the portfolio that we're trying to beat is the S&P 500 buy and hold investor. Their portfolio is up 6.7% year to date. So we still have to catch up to them, but they have softened a little bit during the week because they came down. And I'll show you that during the presentation. I'm going to go through the charts in much greater detail later on in the video, but this is just a snippet. Here at Spy Trader Now, what we try to do is to put more green in your wallet. And the way we do that is we buy, sell, and trade the S&P 500. And there's our portfolio return year to date. Our past returns, this is just a snippet of where our past returns are landed. In 2022, we had a fantastic return of 21% compared to the S&P 500, who was down 19%. So that's a 40% differential right there, which is a fantastic return on investment. And in 2021, we had a 78% compared to the S&P 500, up 28%. And in 2020, just an outstanding year, 100% gains. S&P only returned 15% that year. If you have not done so already, please go ahead and hit that subscribe button, ring that bell to be notified, and do me a solid and smash that like button down right now to help me promote this video. This is just to tell you that the S&P 500 last week lost 1.05%. We'll go through the charts later on in the presentation. The last trade that I made was on February 2nd, 2023, and here's the outline information about the trade, and we are still currently in that trade. This here is the calculator I used for the covered call return, and if you do want this calculator, please head over to spytradernow.com where I give you this calculator and my spreadsheet so that you can watch your trades, and you can download this for free at that website. Okay, so here is also part of the Excel spreadsheet. This here is the trades that we made, and then here's where we can monitor our trades. So in 2023, our last trade was on February 2nd, and here are those returns. We're still in that trade, so we are still there. If you want to sign up for my real-time trade alerts, please go ahead and head over to spytradernow.com. Here is our portfolio because we want to track the performance of our portfolio. So this is our equity curve, and this is where we stand year to date. We compare ourselves against the S&P buy and hold investor, and this is the equity curve of the SPY. The SPY is the ETF of the S&P 500. So the symbol is SPY. That's the symbol that we trade. And here, on a percentage basis, is the two portfolios combined, with the buy and hold investor in pink and the Spy Trader Now portfolio in blue. They've softened up a little. We went flat because we didn't have a trade during the week, and we're going to be flat for the next week because we're still in our trade. This is Jerome Powell, the Fed chair. The last interest rate hike was in February 1st, 2023, 25 basis points. That brought the Fed funds rate down to up to 4.5 to 4.75. Now, Forbes has the terminal rate for 2023 between 5 and 5.5, so we still have some more rate hikes to go. This here is the calendar for the FOMC meetings for 2023. The announcement will be on March 22nd, where Jerome Powell will announce probably a 25 basis point rate hike, but only time will tell, but the expectation is going to be that. I'm pretty confident of that. Now, let's go into what the bond market has to say about the equity market. The bond market currently has an inverted yield curve. This is an extremely negative stance or position for equities. And also an inverted yield curve, which if you're unaware of that what that means is that the 10-year returns on bonds is a lower return than the shorter term duration, the 3-month and the 2-year yields, which are yielding currently a higher yield than the 10-year. This is not normal, folks. It's called an inverted yield curve, and it has also been a precursor to every recession that the United States has experienced. So in 2023, the expectation is that we're going to have 2 downward quarters for GDP growth in 2023, showing that we've had that the country will experience economically a recession. But on the stock market, that may not be a recession. So only time will tell how the stock market will react to what's happening. Another thing that the bond market is telling us is that we have rising interest rates. 1 year ago, the 10-year yield was 1.96. We're currently 3.67. Obviously, a rising interest rate market. That is not a bullish position for equities when you're in a rising interest rate market. It's bearish for equities. So from a bond market outlook, we are in a very bearish standpoint. I got this information from bankrate.com. I'll leave a link down below, but this is the address right here. Okay, so from a seasonality standpoint, where we stand right now, each one of these candlesticks represents 1 month's worth of data for the S&P 500. We're in the month of February. Now, going back the last 20 years on a seasonality graph for the month of February, equities, the SPY, has gone up 65% of the time. It's going to close higher at the end of the month compared to the beginning of the month. This is where we stand right now. And for the month, it's currently up only 0.38%. So we're in a good position from a seasonality standpoint to go long equities, to go long the S&P 500. Here is the long-term 20-year chart of the S&P 500. We were in this downward trading channel, and we've just recently broke out above it. As long as we remain above this resistance trend line here, we're above it at this point in time. As long as we remain above it, that's bullish for equities. On the MACD at default settings, you can see the histogram's gone up. We've bottomed and curled, and we're getting ready to turn up towards the signal line on the MACD. So that's where we stand there. The slow stochastics has already bounced off the 20 and coming up. Here is the intermediate term outlook. We were again in this downward wedge pattern, and now we are broken up above it. As long as we stay above it, we're okay. The 410 is a resistance line that we're monitoring closely because that's the old highs right there. And right now, we are kind of just borderline right along, moving sideways to that 410 resistance line. This is good on the MACD, that we're staying above the signal line, and we're gaining distance between the black line and the red line. All bullish. So we're in an intermediate standpoint, we're in a bullish configuration. For the short-term outlook, we look at the daily charts. On the daily chart, we were in this rising trading range, and we've broken out above it, and now we're moving in a sideways trading range. So we're going to monitor it. Our MACD has topped, come down, and is below the signal line, and the slow stochastics is below the signal line. So we are due right now for sideways to slightward downward action according to the charts that we've seen thus far. This is the VIX chart, which is the volatility index, also known as the fear index. And I was watching this pattern right here, and if we stay below this solid line here, it can be bullish as long as we stay below it. We just popped up above it, but we hit a resistance at the 22 VIX and bounced and came down. So as long as we kind of move sideways here, we're going to be okay to continue to stay long on the S&P 500. If the VIX starts jumping up, that's not going to be good for equities. Mind you, on the trade that I took, which was an in-the-money covered call, we had downward protection, which was very good for us because I anticipated the market to come down slightly, and we're still profiting in this environment, even though the S&P 500 buy and hold investor is losing money. Now here, looking at this 1-year chart, this is with the Think or Swim platform. This is with my broker, TD Ameritrade. Here you can see the -2 and +2 standard deviation lines, and the pink lines are the -1 and the +1. Well, we did not reach the +2 standard deviation, came about halfway between +1 and +2, and we hit a resistance wall, and since it bounced and came down. 95% of all trading takes place between the -2 and +2, and we are still within that 95% trading range. Now, this is the same Thinkorswim platform, but instead of a 1-year chart, we're looking at a 3-month chart. This here is when our trade ends, which is on February 17th. This line here where I have an alert at 400 is our strike price, because I did an in-the-money covered call when I placed that trade on the 2nd. So the market has softened up a little, but we're still profitable. As long as we remain above this line by this expiration date, our trade will be profitable as intended when I placed the trade. As of February 11th, 2023, my market summation for SPY Trader now is that the market is going to pull back. The pullback is going to be small and controlled. Overall, that is a bullish condition, considering that we just risen. We had pretty good growth over the last few weeks for the S&P 500. As you know, I entered into my in-the-money covered call on February 2nd with the February 17th expiration date. We're going to sit with that position for now, and we will reevaluate our position next week. That is going to wrap up this week's episode for SPY Trader Now. Please go ahead and hit that like button if you have not done so already. Subscribe to my channel and ring that bell to be notified when I post a new video. And I wish you good trading.